In the shimmering heat of Houston, Texas, the Enron Corporation's sleek glass tower loomed over the skyline in the late 1990s, a monument to ambition and innovation. To the world, Enron was a titan of the energy industry, a company that had reinvented itself from a sleepy pipeline operator into a global powerhouse trading energy like stocks on Wall Street. Its executives, led by the charismatic Kenneth Layne and the brilliant Jeffrey Skilling, were hailed as visionaries. But beneath the gloss of success, a rot was spreading, a web of lies, greed that would unravel into one of the largest corporate scandals in history. The story began with promise. Enron, founded in 1985 through a merger of two gas pipeline companies, was struggling to stand out in a regulated industry. Kenneth Layne, a Missouri board executive with a Ph.D. in economics, saw a future where energy markets were deregulated, free to flow like currency. By the early 1990s, Layne's vision was taking shape. Enron lobbied for deregulation, and as markets opened, the company pivoted to trading energy contracts, buying and selling electricity and gas futures. It was a bold move, and it paid off. Enron stock soared, and Wall Street anointed it a darling of the new economy. Enter Jeffrey Skilling, a Harvard MBA with a razor-sharp mind and a disdain for traditional business models. Hired in 1990, Skilling pushed Enron to embrace asset-light strategies, shedding physical infrastructure like pipelines and betting big on financial innovation. He championed mark-to-market accounting, a method that allowed Enron to book projected future profits from long-term contracts as immediate revenue. It was a game changer. On paper, Enron's earnings skyrocketed, even if the cash wasn't there yet. Investors didn't question it. They saw only growth. By 2000, Enron's market value hit $70 billion, and Skilling, now president, was a rock star in corporate America. But the cracks were forming. Enron's aggressive accounting hid a troubling truth. Many of its ventures were losing money. Its international projects, like a power plant in India, were mired in debt and underperforming. To keep the illusion of profitability, Enron's chief financial officer, Andrew Fastow, devised a scheme as audacious as it was deceptive. He created thousands of off-the-books entities, special-purpose entities, SPEs, with names like Raptor and Chuko. These shell companies were used to hide Enron's debts and inflate its profits. Fastow, a wiry, intense figure, sold the plan to Enron's board and auditors at Arthur Andersen, who turned a blind eye in exchange for hefty fees. The SPEs worked like magic. Enron would sell underperforming assets to these entities, booking the transactions as revenue. In reality, Enron often guaranteed the SPES loans with its own stock, creating a house of cards tied to its share price. As long as the stock climbed, the scheme held. Employees, many of whom had their retirement savings tied to Enron stock, cheered the rising ticker. Executives cashed out millions in stock options, with Layne and Skilling alone pocketing hundreds of millions. Fastow, meanwhile, siphoned off tens of millions through shady-side deals with the SPEs. In Houston, Enron's culture was electric and toxic. Skilling fostered a cutthroat environment, ranking employees annually and firing the bottom 15%. Ambition trumped ethics. Traders manipulated energy markets, exploiting California's deregulated electricity grid. In 2000 to 2001, they engineered artificial shortages, driving up prices and plunging the state into rolling blackouts. Enron's profits surged, but the human cost was devastating. Businesses shuttered, families struggled, and public trust eroded. Tapes later revealed traders joking about Grandma Millie suffering in the dark. By 2001, the house of cards was trembling. Enron stock, which peaked at $90, began to slip as analysts questioned its opaque financials. A skeptical journalist, Bethany McLean, published an article in Fortune titled, "Is Enron Overpriced?" It was a spark in a powder keg. Inside Enron, whistleblower Sharon Watkins, a vice president, saw the danger. She penned a memo to Layne, warning that the company's accounting practices could implode in a wave of accounting scandals. Layne dismissed her, assuring employees and investors that Enron was sound. But the truth was closing in. Skilling, sensing trouble, resigned abruptly in August 2001, citing personal reasons. His departure rattled Wall Street. By October, Enron reported a $638 million loss and a $1.2 billion right down tied to the SPEs. The stock plummeted. Investors and creditors demanded transparency, but Enron's financials were a labyrinth of lies. The Securities and Exchange Commission, SEC, launched an investigation, and Arthur Andersen's auditors began shredding documents to cover their tracks. In November 2001, Enron admitted it had overstated profits by $586 million since 1997. The stock, now trading at pennies, was delisted from the New York Stock Exchange. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, the largest in U.S. history at the time. Its market value, $170 billion, was zero. 20,000 employees lost their jobs, and many saw their retirement savings tied to Enron stock evaporate. Pension funds and investors worldwide were gutted. The fallout was seismic. Arthur Andersen, one of the big five accounting firms, collapsed under the weight of its complicity, shedding 85,000 jobs. Congress passed the Sarbanes-Oxley Act in 2002, imposing stricter corporate governance and accounting rules to prevent future frauds. The scandal exposed the fragility of deregulated markets and the dangers of unchecked corporate greed. The legal reckoning was slow but relentless. Fastow, who cooperated with prosecutors, pleaded guilty to fraud and conspiracy, serving 6 years in prison. Skilling was convicted in 2006 on 19 counts, including fraud and insider trading, and sentenced to 24 years, later reduced to 14. He was released in 2019. Layne, indicted for fraud and conspiracy, died of a heart attack in 2006 before sentencing. Lesser executives face prison, fines, or both. Sharon Watkins, the whistleblower, became a symbol of courage, testifying before Congress and co-authoring a book. In Houston, Enron's tower stood empty, a ghostly reminder of hubris. The scandal reshaped corporate America, but its lessons were bittersweet. Trust in institutions, corporations, auditors, regulators, took a beating. For the employees who lost everything, the pain lingered. One, a former trader named John Arnold, later founded a hedge fund and became a billionaire, a rare phoenix from Enron's ashes. But for most, the dream of Enron ended in ruin. Years later, the Enron logo, once a badge of innovation, became a cautionary tale. The scandal showed how brilliance, unchecked, could curdle into deceit. It was a story of human flaws, greed, arrogance, and the seductive pull of success at any cost. As the 21st century unfolded, new scandals would echo Enron's, but none would match its scale or audacity. The tower in Houston was repurposed, its glass reflecting a city moving on. Yet the shadow of Enron lingered, a warning etched in history. When ambition outpaces integrity, collapse is inevitable.